Hello and welcome to our roundtable discussion on inheritance tax. It's one of those topics that many families don't realise how they're affected by it. And following November's budget last year, there's going to be some major changes coming into effect over the next few years. So we thought it was something really important that we need to discuss. So today, myself, Tracey Metcalfe, I'm joined by my colleagues, Ed Gooderham, Nick Park and Susie French. So we're going to look at what's changing, how it affects farmers, businesses and families, and what steps you can take to make sure you don't get caught out. So first of all, we're going to start by looking at what is inheritance tax and how it's worked out. So inheritance tax is a tax on the value of your estate when you pass away. You don't pay any inheritance tax if your total value of estate is less than 325,000. This tax-free amount is known as the nil rate band. There's also an additional 175,000 for your home if you pass your home on to your children or grandchildren. So these bands can be passed around between couples. So you often hear about a £1 million tax-free allowance that's used for couples. However, in reality, there's a £2 million threshold where this extra allowance of £175,000 can be reduced. This is known as taper relief. So Ed, would you like to explain how this taper relief works in practice?
Yeah, sure. So residence nil rate band is the top slice that you have as an inheritance tax allowance. So you've got 650,000 for a couple, 325,000 for individuals, and then 175,000 nil rate band each. So 350,000, which is worth a lot of money, and saves you 40% on that amount. The problem is, a lot of people's estates are over £2 million. They don't realise that if your estate's over £2 million, you start to lose this residence nil rate band via the taper. So every £2 that you're above 2 million, you lose £1 of the residence nil rate band. So for example, if you've got an estate for £2.1 million, then you'd lose £50,000 of your 175,000 allowance, or 50,000 or 350,000 if you've got two allowances for a husband and wife. One of the most common pitfalls we see with this is where clients have mirror wills, husband and wife, and the husband or wife dies, the surviving spouse gets all the assets, and suddenly their estate is way above the £2 million because before that they were both below it, and then all of a sudden they've lost all their residence nil rate band if they have over £2.7 million. So one way we can get around this is for clients to look at giving more assets away on first death rather than on second death. Does that help, Tracey?
Yeah, thanks, Ed. So as I mentioned in the intro, there's going to be some major changes coming into effect. And the first one is in April 26, where agricultural and business property relief is going to be reduced. So this has got a big impact on farmers and business owners. So Nick, if you could help explain what the changes are and how it's going to affect farmers.
Yes, certainly, Tracey. So up until April 26, most farmland and business property, business assets qualified for 100% agricultural property relief or business property relief. But after April 26, that relief is reducing. So it's only the first £1 million of each individual's assets that qualify for APR or BPR that will qualify for 100% relief. And anything above that only qualifies for 50% relief. So that's potentially severely restricting the amount of relief and the amount of inheritance tax that somebody's estate can pay. And it's important to remember that that £1 million is attached to individuals and isn't shared between spouses in the same way as the previous allowances that were referred to.
So there's a big change coming into effect then? Yes,
absolutely. Yeah. And it's also very important to remember that also applies to trading assets as well as land and property. So for farm businesses that have got, say, a dairy herd, the dairy herd can be worth many hundreds of thousands of pounds, millions of pounds even. So that can result in substantial inheritance tax charges in itself, let alone the property.
Thanks, Nick. Also, in April 27, there's going to be a big change for pensions. So previously, pensions were outside the scope of inheritance tax and didn't form part of the estate. However, from 2020, April 27, they're now going to be subject to the inheritance tax. So this is a big shift. So Ed, would you be able to explain what it's going to mean for clients and what it's going to mean for clients and why any old advice around this might not hold up anymore?
Yeah, this is a big shift. So for the last, since about 2005, 2006, we've been advising clients to increase their pension pots because they're outside the scope of your estate. So a lovely way to pass assets down to the next generation. So from 2027, April 2027, pension funds will be included. Excuse me. So pension funds will be included in somebody's estate for inheritance tax. What this will mean is that their estate just simply grows by that value that they've got in their estate. I got clients with pension pots that ranging from 100,000 up to 1.8 million pound. And when you're taxing that all at 40%, there's no relief like there is for BPR, APR. It is all part of your estate tax at 40%. Is greatly increased a lot of clients' estates and the amount of tax that their future generations will pay when they inherit the money. So we're spending a lot of time now looking at options for clients in terms of how we can minimize this going forward and looking at planning around that. The other big issue is that if people do leave it as part of their estate and the next generation inherits it, if they're a high rate taxpayer, there's a double whammy where you'll pay inheritance tax on the money and then they're going to pay income tax when they receive it as well, when they draw the money out. So we really need to look at minimizing this for clients, and that can end up being somewhere around 64% tax charge, which is very expensive.
That's a very high rate of tax, isn't it, when you look at it like that?
Yeah, so there's a lot of planning opportunities looking at this, and there's a lot of clients, or a lot of potential clients, who don't know anything about this yet, because obviously it's not in till 2027, and some accountants aren't telling them about these future changes. So it is important now to take a look at your inheritance tax and start making some planning.
That's right, because April 27 will soon be here. It's not that far away when you think of it. So just to make it easier for people to understand, we're going to look at some real world scenarios. So starting with Nick for farming families, what happens if all the assets are in one spouse's name?
Yeah, that's a very good point, Tracy. So if all the assets are in one spouse's name, then there's a risk that they will only benefit from one of the £1 million APR or BPR reliefs. Whereas if assets are split between husband and wife, then after first death, the £1 million of assets can be transferred away from the spouse, so that 100% APR and BPR is taken advantage of. And then on second death, the second £1 million can be taken advantage of. So it's really important as part of estate planning to make sure that the ownership is set up correctly between husband and wife to take advantage of the £2 million bands.
Thanks, Nick. And Susie, a lot of families still have mirror wills. Why is this may not be the best option anymore for those people?
So yeah, typically in farming families, they have what's called a mirror will. They may jointly own assets, but on the first death, the first spouse that dies leaves all their assets to the remaining surviving spouse traditionally. Because in theory, when that second spouse died, all of the assets would get an uplift to the probate value. So if anybody who then inherited those assets sold them, they'd have a nice base cost for their capital gains tax, so in the next generation down. However, as Nick was saying just now, you don't want to end up with one spouse ending up with all the assets in their name. So with a mirror will, the first spouse leaving all their assets to the surviving spouse, you've got, again, one spouse with all the assets. And you haven't utilised the first spouse's £1 million APR, BPR at 100%. And that is lost because at the moment you can't transfer any unused £1 million APR, BPR relief to the second spouse. So when the first spouse dies, you want to transfer some of those assets down a generation, leaving enough left with the surviving spouse that they can then just utilise their £1 million at their death.
So it's really important that they look at their wills as well then in situations like this.
Yes, yes.
Good.
To make sure that any wills are updated.
So far we've looked at farmers, but Ed, can we look at business owners? So if someone passes on a trading company, they obviously get business property relief. But what about when they've sold that business and then they're left with a huge lump sum of cash or investments? What happens then? Yeah,
I mean, that is the big issue. You suddenly turn the asset from 100% business property relief, where you get 100% exemption for IHT up to the £1 million and 20% after that, to an asset that's 100% taxed at 40% if you're over the thresholds. So lots of clients will look at various options. One is obviously gifting down to the next generation. And so you've got to survive 7 years at the moment. So there's a lot of planning with that. And obviously gifting the asset to your children means it's outside your estate. So therefore you've got the issue of divorce, unfortunately, these days. So lots of clients are looking at, is that the best option for them if they want to, because they've worked hard all their life for this money. One of my clients, I always remember quoting me, Ed, inheritance tax is 40%, divorce is 50%. So the divorce is actually more expensive than the inheritance tax. The other issue is you could gift it via a trust. So you could put the money into a trust and therefore pass it to the next generation that way, but you've still got some control over it. So it isn't necessarily going to be caught by divorce issues, depending how the trust is set up and what you're using it for. So that's another option that you could look at for clients with lots of cash. The third one is to look at investments via an IFA that are exempt for IHT. So you might be able to invest in things where you get business property relief within 2 years of owning the assets. These shares in trading companies, basically, they're specifically run by Octopus and a few others, which are very tax efficient, but not most exciting. So you might be getting 3-4% dividends, but you get 100% exemption for the first £1 million for both yourself and your wife if you split it between you. So there's lots of options you can do, but again, it comes back to planning and looking at making sure that you've decided what you want to do with the money long term, because once you've given it away into trust, you can't get it back. Once you've given it to your children, you shouldn't get it back either. So it's just a case of planning and coming up with the best way that suits the client in terms of what their overall needs are for them and their family.
Yeah, you mentioned there about gift relief in the 7 years. What if something happened within that 7 years?
So it depends which way you've given it. If you've given it via to a trust, then that's a chargeable event and they've got the taper relief. So for the first 3 years, you've got 100% that's taxable, and then after that, it drops off each year. The same way it gets taxed if you give it to your children, but it's just treated slightly different in terms of the IHT forms.
So again, it's a taper relief available on it.
Yeah, so reduces so when I say it reduces from 100% down to by 20% each year, it's the 100% multiplied by that rate, the 100%, 80%, 60%, 40%, 20%. Once you live 7 years, it drops out of your estate, it's gone. You don't have to worry about it.
Okay, thanks. And can I also ask you about landlords? Because a lot of them assume that their rental properties counts as a business, but in reality, this is not the case, I understand?
No, this is a big one for a lot of clients who have built up nice property portfolios, that they run it as a business, and it might be classed as a business, but it's not a trading business. And the importance of that are linked to inheritance tax and reliefs. So whereas if you're running a trading business, you get business property relief of £1 million each, but for husband and wife or whoever the shareholders are, or the owners. In a property business, it's not a trading company, they are just investments. And therefore you don't get any relief. It's just part of your estate. So you've got the value of the property, less the mortgages, give you the equity of the properties, and that's what goes in your IHT forms, part of your estate, and that's what you'll be paying 40% tax on. So there's lots again with business property business owners that we talk about by passing some down to the next generation. So you can pass property down via trusts. That's very tax efficient, but it's limited because you can only go up to the 325,000 value before you start paying IHT on it. So there's lots of planning opportunities, but again, it's a lot more restricted than a business property, where if you ran a trading business, you could gift shares into a trust up to £1 million and then keep £1 million yourself, and you've still got control over both £2 million worth each party. So husband and wife could be 4 million, but you wouldn't have that same scenario with a property business, unfortunately.
So going from what you've all said so far, planning is really important. So Susie, I've heard about that a deed of variation can be really powerful. Can you explain how they work and when families might use these?
So a deed of variation is where you have the estate of someone who's died. However, maybe things have changed, maybe tax legislation has changed, and actually all the benefit, you have to have all the beneficiaries agreeing that are affected agreeing to do it. So the beneficiaries agree that maybe what was left in the will was not the most beneficial. So they get together, they agree what they actually think it should be, and you have 2 years to do a deed of variation on the will. But all the beneficiaries are impacted by the deed of variation must agree to it. That's a really key thing. And you have a 2-year deadline after the date of death to do it. After that, it's too late. So in terms of when families might use them, I've seen recently where a farming family with sort of 5-6 million of assets, the first spouse to died, I think about 18 months before the October 2024 budget. Had done a mirror will, obviously not so helpful. And then, you know, up until 2 years after his date of death, it would have been more advantageous for actually to move some of the assets down a generation, leaving in the surviving spouse just enough to utilise the different reliefs and APR and BPR at 100% and move the assets down. Unfortunately for them, they were a prospective client. They had missed the deadline of which they could have changed the will, and that is really key. That 2-year deadline, after that you can't change things. If they had, they would have moved stuff down a generation and left just enough in the surviving spouse so that 1, they have an income, and 2, they will utilise their reliefs at their death. And it would have saved a great deal of inheritance tax.
Yes, this is really important that you get good advice on this before the event.
Yes. This is all about planning.
Yeah. Another area I've heard people mention is about insurance. Ed, can you explain why people would take out insurance for inheritance tax and how it works?
Yeah, so obviously inheritance tax can be very expensive for some clients if they've got big estates. And looking at insurance policies to cover you for a part of it or all of it isn't a bad option, but they can be very expensive. So a lot of clients look at second death cover, which obviously when the first spouse dies, it doesn't cover that, but it covers on the second spouse dying. That can be a lot cheaper rather than insuring both of you individually. It's not very cost effective if you're very elderly or ill. Premiums generally are too high. They can be very, very useful if you're giving gifts. So if you're gifting and you've got a 7-year time clock ticking, you could take out term policy on second death for that period to make sure you're covering yourselves in terms of the potential tax charge. And it can also be decreasing for the 80%, 60%, 40%, 20% as well. So that can be more cost effective. I have a number of clients who do take out a level of insurance, normally on things where they know that the assets can't be turned into cash quickly. So if they're holding property or their main residence could be very expensive. So some clients, their main residence is £1.5–2 million. So you know you're guaranteed to pay inheritance tax on it because you can't get around it. But they might want to take insurance to cover that bit for themselves. So it's not necessarily to cover everything, but possibly to cover part of it.
Okay. And Susie, I understand that you have seen families where this has been successful and to cover short-term risks. Can you explain a bit about that?
So quite often I've sort of seen this where families have made obviously a potentially exempt transfer, so they have gifted assets down and they have insured for in case they haven't survived this, they don't survive the 7 years until it falls out of their estate, and they insure against that. Sometimes they may, because one of the issues you may get with that is if the insurance pays out, it gets added to the estate. So actually, sometimes they put it into trust to make sure it is not included as part of the estate, and it sort of like removes it from the person's estate if they die. So it's just looking at things like that. Quite often IFAs will help with that side of things as well, you know, when they offer the insurance. So it can be a really helpful tool to use to sort of mitigate any risks.
You mentioned IFAs. I'm assuming obviously solicitors are involved a lot in the process of inheritance tax as well, potentially.
Yes, yes. Obviously with the drafting of the wills, to make sure they reflect what's actually needed. And a properly drafted will is so important.
And Susie, can you explain why intestacy and power of attorney are so important pieces of the puzzle in all of this?
So intestacy, this is where you die and you don't have a will. And obviously this does happen. People die either unexpectedly or they just keep kicking the ball down the road and never get to making their will. And they assume that their spouse will just inherit everything. But that's actually not the case. With intestacy laws, the spouse can inherit £322,000. After that, they receive half of anything above that, and the children receive half equally of the remainder over the £322,000. There are sort of more rules about jointly owned property and how that works, and also where they're tenants in common, the rules are slightly different. All children, for their half above 322, inherit the same equal amounts. And there are other sort of rules about sort of relatives even further away and how they work. However, if there's no living relatives, any estate will pass automatically to the Crown. So that's one thing to remember. If you want your estate to go to someone that is not the Crown and you have no living relatives, make sure you make a will that actually does what you want it to do.
And you hear so many people who haven't got a will made at the moment, don't you?
Yeah. And then there's also powers of attorney, because obviously one of the things you have to be is you have to be mentally capable to make these decisions. So there's two sorts of powers of attorney. They're both lasting powers of attorney. One is for your financial affairs and one is for your health. If you want to make a power of attorney about your financial affairs, you have to be mentally capable of appointing a power of attorney when you do it. So it can't be when you're so far down the road that you're no longer capable of making your financial decisions. You need to make it while you're capable of choosing someone. A health lasting power of attorney, you don't have to have the mental capacity to make it. It can be made for you. But a financial one, you must have the mental capacity. So that's very important. So it's something to do while you're doing all your planning of your wills and everything else, while you're capable of doing it.
Thanks, Susie. I'm just going to throw this one out there. So, because it involves a lot of planning, in a time frame, what's most important between now and 2 years, and say 3 to 7 years, and beyond that, 7 to 10 years? Anyone can.
I'll start because I haven't chipped in for a bit. So, I mean, I always think the most important thing to do to start off with is to understand exactly what your assets are, because that's the starting point for any planning. Roughly what the value of the assets are, exactly who owns what, and that's very often not clear with farm businesses, particularly exactly how the property is owned, and then you can understand what the level of inheritance tax risk is, so you can use that information then to make decisions about how you want to organise things. So that's the starting point.
I'd probably chip in and say, what do you actually want to achieve with your estate? It may not, there may be different drivers that impact it, whether you want it to be a tax efficient answer, whether there are more important issues within your family. But what on a good day would you like to achieve with the best planning you could get? And then work your way down the list of what's important, because you may not achieve everything that you want.
All right.
A lot of clients, there are certain assets they want to hold on to. I have a lot of clients when I do inheritance tax planning with them, and things like premium bonds. Husband and wife love getting that little text on the second of the month saying they've won a prize. And so you don't actually have to give everything away as long as you're happy with what the cost of it's going to be. And like Susie said, it is what they're trying to achieve. So I'm not a great fan of people giving their houses away, because then they have to pay a market rent to stay there. And also, do you want, if anything happens to your children and you're left with a spouse who's owning your house that you're living in, who aren't your offspring, do you want them deciding what happens? So I often say to clients, look, I prefer most of my clients to keep their house, keep the assets they want to keep control over, and then look at the ones they don't need to pass on. But it is all about, like Susie said, asking them what they want to do, what they want to achieve, and then looking at how we can help reduce that tax liability for them. And my personal belief is that all tax is optional. You can actually avoid inheritance tax totally if you wanted to. And you have some clients who are so obsessed with not paying any tax, they might want to give their house away or take equity release out on their house. Now, that's very high risk in my view, but that's up to them. That's not the advice we'd give them, but they're the options that are out there.
Yeah, and you've got to be certain that you retain enough assets so that you've got financial security and a suitable income stream for your retirement or whatever stage you're at. So that's more important than saving tax as well.
Yeah, you need enough to live on as well, don't you?
Yeah.
So before we wrap up, there's some really big myths out there about certain things, and I think some of these have been touched on already as we've been talking. So the first one is we've got £1 million relief, so we're fine. Is that true?
It all depends. Like we said, if they've got more than £2 million of estate, then they probably haven't got £1 million to play with. And the other issue, if you don't think about it, is how values increase over time. So whether they've got investments or property, they might have done an inheritance tax review a couple of years ago, and their values might be £1.5 million. But how much are their pensions worth now, which weren't probably part of it then? How much is the business now worth, which might be in cash in the future, and therefore it won't be 100% BPR. There's lots of things that can change, and this £2 million, £1 million everyone thinks they have, like I say, they might not have.
And they might not have the right assets to actually utilise those reliefs. So it's not as simple as just £1 million each.
Yeah, and another thing, inheritance tax, the nil rate band hasn't changed for many, many years, and is still frozen until 2030. So even though house prices are increasing and everything else is increasing, that nil rate band has stayed the same. So the other one, rental property, which Ed's already touched on this, is a trade in business, and it qualifies for business property relief.
Unfortunately, people do get bad advice and are told that they get relief for these things. Excuse me. You need to just look at get some decent advice on terms of what assets you've got. Like Nick said, who owns what, and then look at what the options are. Furnished holiday lets, obviously, that's been abolished now, which is another thing that people might have been holding on to in the past. So they're just classed as rental properties now as well, which is obviously affecting farmers and just landlords. So there's all these issues that need to be reviewed. And obviously you've got other things that are falling into being taxable, like pensions now as well. So people just need to take the time to get some planning.
Yeah. And you mentioned earlier about obviously gifting your house away. So what if I want to gift my house away to my children and live in it? Will this avoid inheritance tax?
Nick, can I answer that one?
Yeah, so generally the answer to that is no, because it's what's called a gift with reservation of benefit. It's possible to get around that by paying your children a rent to live in the house. And for some people, that's a sensible thing to do. But for a lot of people, it's not a sensible thing to do because essentially there's going to be a tax liability that has to be paid on that rental income. So there's ongoing costs associated with it. So it's possible to do it, but it has to be done with great care and caution and understand exactly what the implications are.
And what determines what rent you pay?
It would be whatever the market rent would be for that house.
Okay. And Susie, mirror wills are always best.
Definitely not anymore. You need to actually start planning and come up with a plan to make sure that both spouses, if they're both involved in the business and have assets, actually utilise their £1 million APR, BPR at 100% fully each. And in mirror will, they may lose that.
Thank you. And Nick, as long as I do nothing before April 26, I'm all right. I'm covered.
So April 26 isn't really the key deadline from a tax planning perspective. The only thing you can do to optimize your tax position is die before April 26, which generally isn't considered to be a good tax planning option. But it's certainly very frightening for some, very elderly clients who, up until a few months ago, leaving the farm to their children was the most sensible thing to do as part of their estates. And now, if they die after March 26, there could be a substantial inheritance tax, or there will be a substantial inheritance tax. And it's quite difficult for them to do anything about it at this stage because they have to survive 7 years of any gift in order for it to fall out of their estate. So tax planning for them is more complicated. So I think the important thing with this is to look at your overall position, as I said earlier, assessing exactly what assets you've got, what your inheritance tax risks are, and then deciding what's sensible for you to actually give away as soon as you can, assuming you've got time to do it, so making sure that you end up with the optimum value of estates.
Yes, that's really hard for people who, like you said, are at that age where they might not have time to plan. So thank you all. We can clearly see that inheritance tax is complicated and is going to get more complex as the changes come into effect in April 26 and 27. So the message is, don't wait. Planning is essential. Early planning is essential, and it can make all the difference for the future. So if you're unsure about any of these rules and the tax rules, it's best to speak to a financial advisor or obviously an accountant. Speak to us. We're happy to sit down with you, review your wills, your pensions and your assets, and show you what options are available to you. So thank you, Ed, Nick and Susie. Thanks for joining me today and for this discussion, and thanks you all for watching.